Ladies and gentlemen, welcome. My name is Alex Dworkin and I'm a managing partner at 40 Capital. We specialize in one-of-a-kind mathematical approach to the stock market where we calculate the market and individual stocks in three-dimensional space. And when we do, essentially perfect order emerges. And by using some of the time variables we've developed over the years, we can then predict exactly what any underlying stock or the overall stock market will do going forward. And typically we can do it on multiple time frames, whether we're talking about extremely long time frame or short-term intraday, doesn't really matter. We can typically, if the structure is there, we're able to calculate it, then we'll be able to project exactly what that underlying equity is going to do. I personally believe our approach is very similar to what Jim Simmons was able to accomplish at Renaissance Technologies, if you're familiar with Jim. So the output of our work, or our primary objective as a firm, is to essentially identify the next NVIDIA, Apple, Bitcoin, Tesla, Microsoft. We're looking for those very important stocks that will increase in value 2x, 5x, 10x, and more over a relatively short period of time. And we do that by having the ability to scan the entire market. We have developed a very powerful software that, for example, scans the entire S&P 500. It calculates everything in three-dimensional space, and then it uses time variables that we've developed over the years in order to identify those equities that are, for example, about to put in important bottoms, and then subsequently run up at that very significant multiple of, let's say, 2x, 5x, 10x, and so forth. So that's our bread and butter. That's where we specialize in. Hence this particular title that you see on the screen in front of you. So today we're going to be looking at interest rates. We're going to be looking at the benchmark 10-year note. And let me minimize this for a second. So 10-year note, very interesting what's going on right now. Let me just give you a very brief history lesson of having the top here in 1982 and then subsequently having a major bottom here in 2020. Okay, so for those of you who are not familiar, what you're looking at, the triangles, we call them cycle composites. And what we found over the years is there are multiple cycle composites running in any given stock or whatever financial instrument you're analyzing. So, and the bottom composites are responsible for the bottoms in any particular stock, and the top composites are responsible for the tops. To make matters more complicated, we typically have multiple composites running in any given stock at any given time. So I typically use Dow Jones as an example. So we have two composites running there at any given time. But if you put it together, you're able to essentially replicate what you see on the stock market two-dimensional time and price chart. Okay, so as you can see here, we had an important bottom here, an important bottom here, an important bottom here. This was the final bottom, the major bear market bottom for the yields, if we're talking about the yields, and the completion of this bear market in yields that started in 1982. So that's what approximately 38 years that it took from the top to the bottom here. So what we're witnessing here is very, very significant. We are actually able to call it in both price and time just around COVID, and ever since then interest rates have been increasing, although they've been kind of flat over the last couple of years. Okay, and the tops you see here are, they were not major tops. It was a structural bear market in yields. So we've seen spike here, spike here, spike here, nothing very significant or important, but the major bottom that we saw here is indeed very important. So the question, or at least our forecast, this is one of our weekly stocks that we follow, so we do an update every twice a year. So last time we looked at this at the beginning of the year, we had an outstanding forecast that is essentially still in play. And at that time, ever since this bottom, we were projecting that 10-year note will top out at approximately 5%. Sorry, not 5%, 5.8%. This particular peak was located at 5%, so we got very, very close. And once that top is in place, we were expecting decline into I believe 2.7%, this particular mid-cycle bottom, and then from there will increase higher. So that forecast had to be adjusted a little bit. Let me pause here. It's not adjusted. As a matter of fact, the cycles can be running a little bit late, but we have an alternative interpretation of what's going on with interest rates, because as you know, they've been stuck in this trading range for almost 2 years. And the interpretation is, as you can see here, we're basically stuck in an interference pattern where the mid-cycle top and the mid-cycle bottom arrive around the same time, and they continue to essentially dilute themselves and not be directional in any way. So for example, here we can see that we are very directional. We are put in a major cycle top right here, and then subsequently we had a major cycle bottom here. So that predicts a directional move. But when we have cycle interference, as we are seeing here, essentially what is indicating a flat move going forward. Now there's a lot of macroeconomic talk, a lot of political discussion in terms of lowering interest rates and doing it as soon as possible. Of course, we know that Trump wants to lower interest rates, but it's a fertile discussion at this point in time. I'll get that in a second because I forgot to mention this particular chart. So if you look at this particular chart, this is yet another representation of our three-dimensional calculations. And what it indicates is that it indicates all possibilities of where the market has the potential of topping, at least in this particular case, short term. We're not talking about a very long bull market and yields that started right here at the bottom. It'll take probably decades. Just as long as it took it to decline, it'll probably take just as long to increase. And we have historical precedent. Before this 1982 bottom, I believe the rates started grouping up higher in early 60s. So it takes a long time. This was the bottom, okay? So nevertheless, shorter time frame indicates that we should top at around this particular level. So that's why one of the reasons we had a projection of 5.8% is because we thought that the yields will reach into this area before they top. But it appears that market interference pattern came in before that move could be completed. And once again, there are two interpretations. It will still be completed and soon, or the secondary interpretation is that we are within the confines of the interference pattern, and that will continue for at least over the next 2 years. So you shouldn't expect any moves, any significant moves up and down. And this is more or less being confirmed by, let me pull up the current structure of the, so everybody knows, I kind of find the fundamental discussion of lower interest rates a bit funny because, so this is a 6-month Treasury bill. Everybody knows, well, I'm not sure if everybody knows, but a lot of people know that Fed typically follows the short-term interest rates. So if we look at this particular chart, this is once again 6 month. They follow 6 month. And I'll give you a perfect illustration. Let me zoom out of this chart. So right here in COVID bottom, right? Let's say early 2020. That's when the interest rates bottom on this chart. Let me pull up that chart once again. Right here. So that's the bottom where we're talking about. Okay. But notice that the interest rates begin to increase, and they begin to increase quite substantially from this bottom. Okay. Well, the Fed didn't start to increase interest rates until right here. Okay. That's when they really started to increase interest rates. So essentially, what the point I'm trying to make is they always follow the short end of the curve, and that's one of the reasons that Powell has been hesitant to decrease interest rates, because they've been essentially flat for the last couple of years. And if we zoom in here, this is the 25 basis point cut that everybody's talking about. It can be viewed here. So simply, came off 4.27, 2.2, 2.5% to lower 4%, and this is what everybody's excited about. Now, the Fed will continue to follow the curve, and at least according to our calculations, it is once again suggesting that we will continue to see or continue to be stuck in this interference pattern where one of the tools we have here is we can pull in top and bottom cycles, and then we can run them all together. So this is more of a insider analytical perspective, but this black line is essentially indicative of what we should expect going forward from this particular 10-year note. And as you can see, it peaked right here, and it's kind of flat lines into 2029, 2028, increases a little bit more here. So that's what our projections essentially indicate, that we're going to remain around that 4.3 plus or minus 50 basis point where the interest rate's going to jump up and down. And politics and the Fed aside, I think that's what we're going to see from the interest rates going forward. But the primary forecast would be a little bit more ideal, where we assume that cycles perhaps are running a little bit late. And once again, if that is the case, we'll get that spike higher into 5.8 and then decline into 2.7. That's actually going to be a much better analytical perspective of what's going on with interest rates, because once we know the top, we can pick out the bottom, and then subsequently we know what it's going to do going forward. But at least for the time being, the market at this juncture has adjusted our forecast a little bit to the point where it's indicating that basically interest rates will remain flat going forward, regardless of what the Trump administration wants. So that's it for today. Just a very quick reminder, don't forget to subscribe. We do daily videos. We're going to be back with either a targeting analysis or a fast mover tomorrow. In addition to that, we have a webinar coming up on August 22nd. Last one was very successful. We're limiting this one to 10 people only, so link in the description of the video if you'd like to sign up. We talk about our mathematical calculations. We talk about the proof and how we calculate the market, why it is mathematically structured, and so on and so forth. So, but the primary selling point of the webinar is we actually cover the analysis for the overall market. We typically shy away talking about it in this free forum because it's our bread and butter, but we'll talk about it in our webinar. So if you'd like to get access to that information, please go ahead and register for that webinar. Also, the final link there is a link to the 30-day free trial to our service. It is relatively expensive, but if you request a free trial, we'll go ahead and give it to you. It is contains the whole body of information and targeting analysis for stocks like the stocks I talked about this week, or even interest rates and things such as that. So please click on the link and do a request if you would be interested in that. Thank you very much for your time. We'll be back with another update tomorrow. Bye-bye.